here's what nobody saw coming. While the world braced for an oil market crash, crude prices just delivered their biggest Monday surge in weeks. And the reasons behind it might surprise you. Crude oil markets defied expectations this Monday, climbing more than 1% and clawing back significant ground from last week's brutal sell-off. But here's where it gets controversial. This rally happened despite OPEC Plus announcing they're flooding the market with even more oil. How does that make sense? The answer lies in a geopolitical chess game that's reshaping global energy dynamics right before our eyes. Brent crude futures jumped 80 cents to reach $66.30 per barrel. That's a solid 1.2% gain by early Asian trading hours. Meanwhile, U.S. West Texas Intermediate crude wasn't far behind, surging 75 cents, 1.2%, to hit $62.62 per barrel. These numbers tell a story that goes far deeper than simple supply and demand. Let's rewind to understand why this bounce matters so much. Just last Friday, both oil benchmarks took a devastating hit, plummeting over 2% after disappointing U.S. employment data painted a grim picture of energy demand ahead. The week ended with losses exceeding 3% across the board, the kind of decline that usually signals trouble brewing in global markets. So what changed overnight? Two major forces are now pulling oil prices in opposite directions, creating the perfect storm for market volatility. First, let's talk about OPEC Plus's surprising move. On Sunday, this influential group, which includes traditional OPEC members plus Russia and other key allies, announced plans to ramp up oil production starting in October. Saudi Arabia, the group's de facto leader, is clearly making a strategic play to reclaim lost market share, even if it means accepting lower prices in the short term. But here's the part most people miss. The production increase is actually much smaller than what markets feared. 8 OPEC Plus member countries will boost output by just 137,000 barrels per day come October. To put that in perspective, that's dramatically less than the massive 555,000 barrel per day increases we saw in August and September, and well below the 411,000 barrel jumps from June and July. This restrained approach caught many analysts off guard. After all, OPEC Plus has been systematically unwinding production cuts since April, following years of deliberate supply restrictions designed to prop up oil prices. The timing seems particularly puzzling given that winter months in the Northern Hemisphere typically bring reduced energy demand, exactly when you'd expect an oil surplus to develop. Satoru Yoshida, a commodity analyst at Rakuten Securities, offers this insight. Buying emerged as the output increase was smaller than anticipated, while fading prospects for peace in the Russia-Ukraine war and views that Russian oil won't flood the market also supported prices. In other words, traders are betting that geopolitical tensions will keep Russian crude off international markets, regardless of how much OPEC Plus decides to pump. And this is where the controversy really heats up. Russia just launched what Ukrainian officials are calling the largest air assault of the entire war, setting Kiev's main government building ablaze and killing at least 4 civilians. This escalation comes at a critical moment when global energy markets are already on edge about potential supply disruptions. The timing couldn't be more significant. U.S. President Donald Trump announced that individual European leaders will be visiting America this Monday and Tuesday, specifically to discuss strategies for resolving the Russia-Ukraine conflict. Trump expressed frustration with the war's current trajectory, stating he was not happy about the situation, while maintaining his characteristic confidence that a resolution is within reach. But here's the million-dollar question. Can diplomatic efforts really cool down a conflict that's now reached unprecedented levels of intensity? And more importantly for oil markets, will potential new sanctions on Russian energy exports outweigh the impact of increased OPEC Plus production? Toshitaka Tazawa from Fujitomi Securities believes the market dynamics are clear. The oil market was supported by relief over OPEC Plus's modest output hike and a technical bounce following last week's decline. Expectations of tighter supply from potential new U.S. sanctions on Russia are also lending support. This creates a fascinating paradox for energy traders. On one hand, you have OPEC Plus deliberately adding more barrels to global supply. On the other hand, the threat of expanded sanctions could potentially remove significant volumes of Russian crude from international markets. It's like watching two heavyweight fighters circle each other in the ring, and nobody knows who will land the first decisive punch. For those new to oil markets, here's why this matters for everyday consumers. When crude prices fluctuate this dramatically, it eventually shows up at gas pumps, heating bills, and the cost of virtually everything that gets transported. The global economy runs on energy, making these price swings far more than just numbers on a trading screen. Looking ahead, Goldman Sachs just released weekend projections that add another layer of complexity to this puzzle. The investment bank expects a slightly larger oil surplus in 2026, driven primarily by ramped-up production across the Americas that will more than offset any reduction in Russian supply and stronger global demand growth. Interestingly, Goldman Sachs kept their price forecasts unchanged for 2025, but projects 2026 averages at $56 per barrel for Brent crude and $52 for WTI. Their analysts note that risks to our 2025-2026 price forecast are two-sided but skewed modestly to the upside, essentially hedging their bets while acknowledging that geopolitical surprises could push prices higher than expected. This brings us to the elephant in the room that nobody wants to discuss openly. Are we witnessing the beginning of a fundamental shift in global energy geopolitics, or just another temporary spike driven by headline-grabbing events? The evidence suggests this is about much more than short-term market volatility. OPEC Plus's cautious approach to production increases signals they're concerned about demand destruction if prices fall too low. Meanwhile, the escalating Russia-Ukraine conflict shows no signs of resolution, meaning supply disruption risks will likely persist for months or even years to come. What makes this situation particularly intriguing is how it challenges conventional wisdom about oil market dynamics. Traditionally, announcements of increased production would send prices tumbling. Instead, we're seeing crude futures rally on the news, a clear indication that traders believe supply security trumps absolute supply volumes in today's geopolitical environment. So, here's the controversial question that's dividing energy analysts right now. Is the current oil price rally sustainable? Or are we setting up for an even bigger correction once geopolitical tensions eventually cool down? Some argue that $66 plus Brent crude is justified given ongoing supply risks and recovering global demand. Others contend that fundamentals don't support these levels, especially with OPEC Plus committed to bringing more barrels online. The answer likely depends on factors that remain impossible to predict with certainty. How far will Western sanctions on Russian energy expand? Can diplomatic efforts genuinely de-escalate the Ukraine conflict? Will OPEC Plus stick to their modest production increase schedule, or will they accelerate output if prices climb too high? What's your take on this energy market chess match? Do you think oil prices are headed higher as geopolitical risks intensify? Or will increased OPEC Plus production eventually overwhelm demand and send crude tumbling back toward $50 per barrel? The debate is far from settled, and your perspective on global energy security could shape how you view these dramatic price swings. Share your thoughts. Are we looking at a new era of structurally higher oil prices? Or just another boom-bust cycle in disguise?